All right, once again, good evening. Last week, we looked at economic value added. As a measure of performance. Of course, our discussion is still on divisional performance evaluation. To evaluate performance, you can look at financial performance measure, such as return on capital employed. That is one. Number two, residual income. And you can evaluate performance using economic value added. We explained last week that economic value added is very similar to residual income. However, economic value added uses economic profit and economic capital employed. Unlike the residual income that uses accounting profits and accounting capital employed. To calculate economic value added, economic value added is calculated as look at it. Net operating profit after tax minus brackets adjusted capital employed multiplied by the cost of capital. We now explain how to determine your net operating profit after tax, otherwise known as the NOPAT. To estimate your NOPAT, NOPAT is calculated as 1. We are going to pick the profit after tax. You are going to pick your profit after tax. Then add back the following items. The following items should be added back. 1. Accounting depreciation. 2. Provision for doubtful debt. 3. Provision for deferred taxation. And all other provisions. 4. Add back non-cash expenses. 5. Add back interest paid net of tax. So you are going to deduct these items. Then you are going to obtain your net operating profit after tax. That is your NOPAT. That is your working one. Next, your adjusted capital. Adjusted capital employed, you are going to pick opening capital employed balance. Pick opening capital employed balance, then add the following items: operating lease assets, operating lease assets should be added back. Non-cash expenses should be added back. Increase in provisions will be added back. Then less decrease in provision. Your resulting figure is your adjusted capital employed. Lastly, you have your cost of capital. Your cost of capital is represented by the weighted average cost of capital. Your cost of capital is represented by the weighted average cost of capital. To calculate this, your work is equal to cost of equity multiplied by the percentage of equity plus cost of debt after tax multiplied by the percentage of debt. These three variables are required to calculate economic value added. We explained this last week, and we can only solve one question because of non-availability of the device. Tonight, we are going to take one more question so as to round up this topic. Please refer to your study pack. Divisional performance, page 79. Please check page 88, question number 8. Please check your study pack, page 88, question 8. Let us review this question together. Please refer to your study pack. All right. Are we good to go, please? Are we good to go, please?
Yes, sir.
All right. Ibok Power Nigeria Limited, in brackets, IPN, is a power utility company providing power distribution services to the public and businesses of southern Nigeria. The company was formed when the government-owned power holding company of Nigeria was broken up into regional utility companies, one of which was IPN, and was sold into private ownership over 4 years ago. As a vital utility for the economy of Nigeria, power services are a government-regulated industry. The regulator is principally concerned that IPN does not abuse its monopoly position in the regional markets to unjustifiably increase prices. The majority of the services, in bracket 80%, are controlled by the regulator, who sets an acceptable return on capital employed and ensure that the pricing of IPN within these areas does not breach this level. The remaining services, such as provision of meters and contract repair services, are unregulated, and IPN can charge a market rate for these. The regulator calculates its return on capital employed figure based on its own valuation of the capital assets being used in regulated services and the operating profits from those regulated services. The target pre-tax rose set by the regulator is 6%. The target pre-tax return on capital employed set by the regulator is 6%. If IPN were to breach this figure, then the regulator could fine the company. In the past, other such companies have paid fines amounting to millions of naira. The board of IPM is trying to drive the performance for the benefit of the shareholders. This is a new experience for many at IPN who left the public sector 4 years ago in order to try to better communicate the objective of maximizing shareholders' wealth. The board has decided to introduce economic value added as the key performance indicator. The finance director has provided the following financial information for the year ending 30th September 2018. IBOC Power Services. We have the regulated and non-regulated. We have revenue from regulated service, revenue for non-regulated service, total revenue of the company. We have the operating cost. We have the operating profit. We have the finance charge for the company as a whole. Taxation is 25%. Next, we have the capital employed figure as measured from the published account of the company. We are giving for 2018 and 2019. We also have the capital employed figure as measured by the regulator. Additional notes. Note number 1. Total operating costs include depreciation, provision for doubtful debt, research and development, non-cash item. Note number 2, economic depreciation is assessed to be 41.5 billion in 2018. Economic depreciation includes any appropriate amortization adjustment. In the previous years, it can be assumed that economic and accounting depreciation were the same. Note number 3, tax is the cash paid in the current year, 4.5 billion. An adjustment of 0.25 billion for deferred tax provisions. There was no deferred tax balance prior to 2018. Note number 4. The provision for doubtful debt was 2.25 billion on the 2018 Statement of financial position. Note number 5. Research and development is not capitalized in the accounts. It relates to a project. It relates to a new project that will be developed over 5 years and is expected to be of long-term benefits to the company. 2016, 2018 is the first year of this project. Note number 6. Cost of capital of IPN. Equity 16%. Debt pre-tax 5%. The capital structure of IPM %40 equity, 60% debt required. Evaluate the performance of IPN using economic value added. The question is very direct. Evaluate the performance of this company, IPN, using economic value added. If you are faced with questions of this nature, what is the formula for economic value added? State the formula for economic value added. Let's go to this. Please look at the screen. Calculation of economic value added for year 2018. Look at the formula. NOPAT minus, open a bracket, adjusted capital employed. Let me put that complete. This should be adjusted adjusted capital employed multiplied by the cost of capital. That means we require 3 variables if you are to calculate economic value added. That means for me to calculate economic value added, I require 3 variables. What are these variables? NOPAT, net operating profit after tax. That is number one. Number two variable, adjusted capital employed. Number three variable, cost of capital. We now go to working number one. Calculation of NOPAT. Please get your writing material. Calculation of NOPAT. Pick your profit after tax. Go to the question. Please look at it. Profit after tax, 17.75 billion. Pick this figure. 17.75. Next, items to be added. 1. Depreciation. Go to the additional notes. Please, depreciation for 2018. 29.5. I will pick this. 29.50. 2. Provision for doubtful debt. Item number 2 to be added. Let me shift this more. 29.50. Item number 2 to be added. For 2018, provision for doubtful debt is 1 billion. $1.00. Item number 3, research and development cost. Look at the cost incurred in 2018. 6 billion. Non-cash item, 3.5. I'll pick this. 6.00. Number 4. Non-cash item, 3.50. Next, number 5, interest net of tax, that is interest, into brackets 1 minus tax. This is what we call interest paid net of tax. Go to the question. Is there any interest paid? Go and check your income statement. Look at it, please. Finance charge. Finance charges. This is the interest. $11.5. Your tax rate, 25%. Look at the working place. 11.5 into bracket 1 minus 0.25. Please work this out. That is the interest paid net of tax. Please compute this and tell me.
8.625. 265.
8.265. 8.2.
8.625.
It is correct.
8.625. 625.
8.625. Then go and check. Do we have provision for deferred taxation? Provision for deferred tax. Go to the additional note. Look at note number 3. Tax is the cash paid in the current year. 4.5 billion. And an adjustment of 0.25 billion for deferred taxation. There was no deferred tax balance prior to 2018. That means provision for deferred tax was first made in 2018. This provision does not involve cash flow. All provision must be added back to your accounting profit. Add back. $0.25. These items should be calculated and added back to your accounting profit after tax. Please add. Somebody should sum for us. $29.5 plus 1 plus 6. Please, somebody add. Yes, the answer? Final answer, who is adding?
$48.875.
48.875. Look at it. 48.875. Next, items to be deducted. 1. Economic depreciation. Go and check your note number 2. Economic depreciation is assessed to be 4.5 billion in 2018. Pick this figure straight. $41.5. Next, amortization of development costs. Yes, Rose.
Sir, good evening, sir.
Good evening.
I'm trying to get how they got that 8.625. I'm not getting same answer.
Oh, yeah, carry your calculator.
I'm with my calculator, sir.
Interest. How we got what?
8.625.
Oh, yeah, carry your calculator. Your interest is 11.5. Into bracket 1 minus the tax rate. The tax rate is 25%. We are do the working. 11.5 bracket 1 minus 0.25. Close your bracket. Apply your calculator.
Okay. I've gotten it.
All right. Dean.
Yes, sir. This provision for doubtful debts, we use 1 billion here. But according to the notes to the note that say provision for doubtful debt was 2.25 billion on the 2018 statement. So, but we didn't use that one. We used the
Which
one
statement, please complete it. Which statement?
On the financial position. Statement of financial position.
Okay. Statement of financial position is not your statement of profit and loss.
Oh, okay. Yes, I know.
Your operating profit will come from your income statement, not your statement of financial position. Let me repeat that. For you to get net operating profit after tax, you are going to look at the items that is affecting your income statement. For example, total operating costs. This will affect your income statement. Operating cost is part of your income statement. But look at this item. The provision for doubtful debt was 2.25 billion on the statement of financial position. This information will affect your capital employed. Now your net operating profit. So we are still coming back to it. We have picked 1 million because this is the one that affected our operating profits. So you must know the item that will affect your profits. The items that will affect your capital employed. Your capital employed figure is derived from your statement of financial position, while your net operating profits is derived from your income statement. So we are still coming back to that. All right, next. Amortization. Amortization of development costs. Let us go to this. Development costs incurred in 2018, 6 billion. Look at note number 5. Research and development is not capitalized in the accounts. It relates to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. 2018 is the first year of this project. This cost will be amortized for 5 years. What is the meaning of amortization of costs? It means to spread your costs for the number of years the project will run. This project is for 5 years. So we are going to spread the cost for 5 years. Look at it, please. To calculate that, 6 divided by 5. Development costs incurred is 6 billion. The project will run for 5 years. So we are going to amortize the cost for 5 years. Please divide 6 billion by 5 years. What is the cost to be taken every year? One point what? $1.2 billion. These two items will be deducted. Sum of this, that will give me 42.7 deducts. You can now get your NOPAT. $17.75 plus 48.875 minus 17.75 plus 48.875 minus 42.7.
And we are not saying no.
You are not seeing it. You are supposed to do it for me now.
That
Can't
will
you
be
see my screen?
23.925.
23.925. Can't you see my screen?
We can see it now.
And someone say, we are not seeing it.
Yes, before it's covering the listing.
Oh, before it stopped, okay. This is your NOPAT. Net operating profits after tax. You now move to working 2. Adjusted capital employed. You are going to start with your opening capital employed balance. Let's go to the question. Look at the capital employed. You have measured from published accounts. You have measured by the regulator. Which one are we going to use? For the purpose of calculating ever, for the company as a whole, you are going to use capital employed from the published accounts. For the purpose of calculating ever, for IPN, you are going to look at the published account of the company. Now look at it. 2017, closing capital employed was 318.5. 2018, closing capital employed was 328.5. Which one am I going to pick? I want opening capital employed for 2018. Opening capital employed for 2018. That will be the closing capital employed for 2017. What was closing for 2017 becomes opening for 2018. Therefore, opening capital employed is 318.5. items to be added. Go and check. Do we have operating lease assets? Operating lease assets. Look at the additional notes. We don't have operating lease assets. Number 2, non-cash item. Amount is 3.5. Look at it here. Non-cash item for 2018, 3.5. Add back. Then number 3, do we have increase in provision? Now that will take us to note number 4. Look at the income statement. Provision for doubtful debt is 1 billion. Now look at the statement of financial position. The provision for doubtful debts was 2.25 billion on the 2018 statement of financial position. That means provision for doubtful debt has increased in the statement of financial position. This increase in provision must be added back to the capital employed, because by increasing your provision, you are going to reduce value of the asset. By increasing provision, value of the assets will reduce. Hence, to correct this, you are going to add back increase in provision. Compare 2.25 billion and 1 billion. What is the increase?
$1.25.
In provision for doubtful debt. Look at it, 2.25 minus 1. That will give me 1.25. These are the 2 items that will be added. If you sum these two, 3.75. In this question, there is no decrease in provision. Please add these two together. 318.5 plus 3.75.
3.50 and 1.25 is not 3.75.
That will give us
Sir.
Oh, sorry, this should be 4.
Yes.
Oh. Not 3. So we should have 323.25.
0.25.
Is that not, please?
Is correct.
Our adjusted capital employed is equal to 323.25. You are done with working 2. Your working 3, weighted average cost of capital. The formula is cost of equity multiplied by the percentage of equity plus, open a bracket, cost of debt after tax multiplied by the percentage of debt. Our work. Look at note number 6 and 7. What is the cost of equity? The class is silent. Check note number 6 and note number 7. Equity 16%. Cost of capital of IPN. Equity 16%. Debt pre-tax 5%. Capital structure. Equity 40, debt 60. Equity 16%. You can remove percentage safe. Just pick 16. Multiply by percentage of equity 0.4. Debt pre-tax is 5%. Remove the tax. To remove the tax, just do 5 brackets 1 minus your tax. Multiply by debt 60%, 0.4, 0.6. Our work is equal to 16 multiplied by 0.4 plus 0.75 multiplied by 5. This will give me 3.75 multiplied by 0.6. Please work this out. What is the weighted average cost of capital?
$8.65.
8.65. You can now introduce your percentage back. You can compute your EVA now. Economic value added. Or you can do it up. Look at the formula. ever is equal to our NOPAT 23.925 minus, open a bracket, adjusted capital employed 323.25 multiply by the cost of capital, your work, (8.65%). Please work this out. (323.25 multiplied by 0.0865 27.96112. Look at the ever. 23.925 minus 27.96 1125 1125.
That's negative 2772.1875.
Negative what?
2772.1875.
Negative, okay. Yeah, of course it's negative, I know. The answer here becomes please hold on. There is back. Minus 23.925. My answer is negative 4.036 billion. That is the answer. That is the ever. Negative 4.06 billion. This is the economic value added of IPN. And once you have a negative ever, it's an indication that that company is not performing well. Once you have a negative ever, let me transfer it here. 23.925 minus bracket 323.25 multiplied by 8.65%. The ever will give us negative 4.036 billion. your comments. IPN is performing poorly. The company is not generating earnings for the providers of capital. In fact, the company is destroying the wealth of the shareholder. The wealth of the shareholder. Once you compute your economic value added and you have a negative sign, it's an indication of poor performance. We are done with requirements A. We are done with requirements A. Any question, please?
What is long, sir? What is long figure after the decimal points? So is it not advisable that we approximate it, or we should just, when we are doing this kind of work, we should just leave it like that?
Are you saying if you round up?
I'm thinking that's what I'm asking. That is it okay if we round it up, or it's better we
You
work
can
it out
round
like
up,
this?
it's not a crime.
Okay.
You can round up. That's not a crime. The most important thing is, what is your comments? You can round up to the nearest billion, 4 billion. You can round up to 4.04 billion. But your comments must be very clear. This company is performing poorly. If you look at the meaning of this 4 billion, the management of this company has destroyed 4 billion of the wealth of the owners. $4 billion of the earnings of the business has been destroyed. All right, requirements B. Assess whether NPN meets its regulatory please just 1 minute. Just 1 minute. Assess whether IPN meets its regulatory return on capital employed targets and comments on the impact of such a constraint on performance management at IPN. Let me explain these requirements. The regulator has set a target return on capital employed that a company must not exceed these targets. If you exceed these targets, regulator will fine you. What is the target? Look at it, please. Look at paragraph 3. The target pre-tax rules set by the regulator is 6%. If IPN was to breach this figure, then the regulator could fine the company. In the past, other such companies have paid fines amounting to millions of naira. The board of IPN, okay, that was not. Now look here. The regulator calculates its return on capital employed figure based on its own valuation of the capital assets being used in regulated services and the operating profits from those regulated services. That means if you want to calculate return on capital employed for regulated services, you are going to pick operating profits for regulated services divided by capital employed as measured for regulated services. This is what we are saying. To calculate return on capital employed, the formula is, look at the B parts. The B parts. Calculation of regulated return on capital employed. This is equal to regulated operating profits divided by regulated capital employed multiplied by 100. If you go to the question, Regulated operating profit, 23. Regulated capital employed, 389.5. $23 divided by 389.5 multiplied by 100. Please work this out.
$5.91.
5.91%. And the maximum target is maximum level in bracket target rows is 6%. That means IPM is not breaching the regulatory position. The company will not incur fine. The company is still within the maximum level established. If you go beyond 6.6%, that means IPM could be fined, penalty. Now, what is the impact of this? That means your ability to make profits is being limited because you must not go beyond 6% as far as regulated service is concerned. Test services account for 80% of your business. That means the ability of the company to make more profit from regulated services is being curtailed because of regulatory policy or because of regulatory condition. Any attempt to charge higher price, if you charge higher price, you are going to make more profit. If you make more profit, your return on capital employed figure will go beyond 6%. If this figure goes beyond 6%, your company will be liable to penalty. In order to avoid penalty, you are not charging higher prices. That will have impacts on your performance. Look at the comments here. The company is within the allowed return on capital employed. by the regulator. There is only a minimal scope for increasing profitability of this aspect of the business. As the maximum operating profit on 389.5 million of capital employed is, how do we get this? Compose 6% of 9.5. That is the maximum profit the company can go. Of 6% employed. Three point three seven. That means for IPN, they must look to make profits and increase non-regulated activities, as these are generating much higher operating profit margin. Please, let's round up. The company will have to look at the non-regulated services so as to increase its profits. Now, the implication for performance management are that the need to control costs. You know, for regulated services, you cannot charge price. Government has given you the price you must charge. Government has specified the price you can charge. So the implication is that management will need to control costs. Management will find ways to minimize its costs within the regulated activities. So that they can increase profits. You don't have control over the selling price. That means you are going to focus on the cost of operation. You are going to find ways to bring down your cost of operation so as to be able to make more profits. This can do tight control of budgets or tight observance of budgets and seeking cost savings through efficiency improvements. Number 4, within the regulated areas, within the non-regulated areas, a more entrepreneurial approach can be taken. Performance management in these areas will focus more on growing revenue by expanding your markets and improving your profit margin. So the focus will be on trying to generate more revenue from non-regulated services and trying to reduce your cost of operation on regulated services, so as to be able to boost the profit of the company. Number 5, creation of additional value will be discouraged. But if the additional value created could outweigh the penalty, management should drive more return. What we are saying is, at times, you might deliberately charge higher price so as to make more profit from the regulated services. If you make more profits, your return on capital employed will be higher than the target set. That will attract penalty. If the profit achieved is more than the penalty government is giving you, then you are going to make more profits. You can take the risk. At times, company commits an offense. They are aware that they will pay penalty. By committing the offense, the company will make more profits. The company is prepared to pay the penalty. The profit achieved is far higher than the penalty, the fine. The rules set by the regulator may not provide adequate value for shareholders. Shareholders will not be happy with this because that will limit the ability of the company to make more profits. But again, company must be careful not to engage in deliberate breach of government regulation. All right. We shall stop here. We are done with the question. We are supposed to move to the next topic. Transfer pricing. Our next topic is transfer pricing. But how far can we go tonight?